What the hell is going on with Tesla right now? This stock is down 70% year to date. Oh my goodness. What a bad month. What a bad year. It is up today by almost 2%, but goodness gracious. Now, in this video, I'm going to answer a question that a lot of you are wondering because a lot of you have Tesla stock or considering investing or considering to sell, whether it's the right time to sell, the right time to buy, or just the right time to keep holding on. I'm going to answer that with a clear answer in a second, but bear with me here for a second. Bear with me with this market. I mean, it's kind of funny. So the only person that I've seen in the news right now from the high-profile investors that is still loading up heavily on Tesla at this point is Cathie Wood. So she loaded up on 130,000 shares over the past 10 days, just 25,000 shares yesterday. And I mean, that's absolutely insane. I mean, at this point, I'm not even sure that it's good for Tesla that she's buying so much because she's already kind of becoming the negative catalyst or the negative indicator for any stock she touches. I mean, at this point, she can rebrand ARK to be a tax haven. Because think about it. You buy an ARK ETF and you never have to pay capital tax gains ever again. It's a tax shelter. And at this point, that's all she has to offer. So her loading up is definitely not anything I would use as a positive catalyst or an indicator for the stock. She's taking over Kramer as the negative indicator of what the stock is going to do. Now, on a serious note, we have to talk about fundamentals here for a second. Before there's no way for us to analyze whether it's the right time to buy, to sell, or to hold without looking at fundamentals. I will talk about macro, and I'll talk about all the problems with the stock because we're not going to sugarcoat anything in this video because I want to give you the most amount of value, not just to fluff my ego and talk about how great a stock is. Now, look, fundamentally speaking, the first thing you have to look at is price to earnings with Tesla. I mean, price to earnings with Tesla have traditionally been, unhinged from fundamentals, and rightfully so. I think still it is hands down the best company in the stock market right now, easy. But the problem is that even though it's currently at a historically low PE of about 30, and forward PE is actually even sub 30. The problem is that the markets have changed. The other day I saw an interview with Quentin Tarantino, and he was talking about how he wanted to cast, I believe, John Travolta to play Monsieur Candy in Django, and then eventually he cast Leo DiCaprio. But he said, I really wanted John Travolta when I was writing the script, but then I realized he's like 20 years older than what I remember him. And that's the same thing. You remember the multiples from 2020, 2021, the markets have changed. It's not the same multiple. So even though, for Tesla 30 is low, it's not an objectively low number in this bear market. So this is not some automatic indicator where you mortgage your house and buy more Tesla stock. Now, beyond the fact that the markets have changed, you have to also understand that it's the Fed. The Fed is driving a lot of this downward momentum. They're raising interest. And unfortunately, for long-term Tesla investors, I have bad news for you. This isn't going to change in the next couple of years. Jerome Powell himself said the Fed does not expect to hit 2% inflation before 2025. So at the very least, next year and in 2024, we have similar monetary policy, which means that Tesla will keep suffering from that. There's no way to sugarcoat it, especially when Tesla still doesn't have a $27,000, $28,000 car to compete with the Toyota Corollas and the Honda Civics and whatnot. Until that happens, they're always going to be in that problem. Now, how low can Tesla drop? Because if the next couple of years are going to be tough, I want to explain to you what is the downward exposure. I'm bullish on Tesla. I'm a long-term investor. But you have to understand that if you are staying for the next couple of years, it's going to be a bumpy ride. And in this video, I want to explain exactly how bumpy it can get. Now, look, so far, the indices have dropped pretty heavily, right? The S&P is down 20%. The Dow is down like 10%. NASDAQ is down 34%. So one might think that this is very close to, the bottom. I mean, how much worse can it get? Well, historically speaking, there's a lot more this company can go through with the rest of the market because if you go back and you look at what happened in 2000, you look at what happened in 2008, if this is the next generational crash, similar to those two, I mean, the numbers are quite alarming. The average drop in 2000, 2008 between these three indices was 53% for the S&P 500, 46% for the Dow Jones, and 64% for the NASDAQ, which means that except the Dow Jones, which can drop another 5x from here, we're pretty much only halfway there for the S&P 500 and the NASDAQ. So at the very least, if you take anything from this video, take this. It can get much, much worse. And if the Fed decides to continue with its restrictive monetary policy for longer, this is probably a huge exposure that you have to accept as a long-term investor in Tesla. I mean, this is something that you have to acknowledge. If you're not willing to accept the possibility of losing another 50% on your Tesla stock from this point on in the next 2 years, probably not a good idea for you to invest. But at this point, you may ask yourself, well, Tom, if that's the case, why not just sell and wait 2 years and repurchase Tesla? Great question. Well, let me explain. The problem is that this mentality is called buy high, sell low. You get caught selling into fear and buying into FOMO. This is the classic example of trying to time the market. This is why virtually for like 99.9% of investors, it's impossible. It's very, very hard to time the market. The reason is because human psychology is very, very fickle. Now, I want to point out a very interesting study that I read on Substack from Market Sentiment that actually examined how staying the course looks like over the past 20 years. Because at the very least, this is what you should take from this video. In their example, they've tested human behavior at its finest. They used a bunch of different types of investors and they went through the 2000-2008 crash and they've seen how they performed. So essentially, they had guys put in $100 into the S&P 500 every month, like clockwork. But get this, every time the index, this S&P 500, would drop 10% below the previous all-time high, the three investors will behave differently. One investor will just stop putting in money until the point of return goes back to that minus 10% and above. The second investor would keep on putting 100 no matter what. Just ignore the noise, put in 100, stay the course. And the third investor is absolutely bananas. Whenever the index drops 10% below the all-time high, he doubles down and invests 200 every month. And he keeps doing that until the index goes back up to minus 10% from the all-time high. And then he starts doing 100 again. So double down, stay the course, or hold. Basically, what they found is that between these three investors, the two that had the best performances are the ones who either stay the course or double down. But the differences between the staying the course investor, the one that puts in 100 every month and ignores the noise, is absolutely insane. So they've tested 1998 all the way to January 2022, before all this craziness started. So before this next crash, which is kind of developing for the past year. So what they got is actually very interesting, because the one that stayed the course over the past 22 years, 23 years, generated 330% in returns. The investor that actually held and stopped actually adding to his S&P position when the market dropped 10% below the all-time high made 240%. So over the course of 20 years, 20 plus years, there's that 80% difference between trying to time the market and actually staying the course. And a lot of you may say, well, Tom, this is 20 years. Who has 20 years? Look at what's going on this year and next year. I mean, if you're not thinking in 20-year increments, you're not a long-term investor. I'm sorry. You're just not. Because long-term investing has one goal: build enough for you to retire on. It's not build enough to buy a Lambo next year. It's not build enough to buy a boat in 3 years or a bigger house. The idea of investing, long-term investing, is build a pension for yourself when you actually have to retire. So 20 years is right in that neighborhood. If 20 years is too long for you, you're not a long-term investor. I'm just, it is what it is. At least not by the classic definition. And just to be clear, that guy who did theoretically 330% in 20 years by just putting in $100 into the S&P 500 and ignoring all the noise. He lived through some really horrible shit because during those two crashes, I just told you, the S&P 500 dropped on average 50, the NASDAQ dropped on average 64, and the Dow dropped 46. So they lived through a lot of fear. But staying the course actually makes sense. But it's not without pain. And look, it's not a US problem. It's a global thing. The world has printed too much money, and now we have a global inflation problem, and every single central bank in the world is trying to put this genie back in the bottle, and the price is going to be paid by investors and everyday people. Even the IMF, who, by the way, I thought is the international MFers before I did the video, but apparently they're called the International Monetary Fund, they're guiding for 50% less GDP growth next year in 2023. And that's not something you take lightly. So the economy, the global economy, the US economy in 2023 is not going to be better off than this year. What do you do with your Tesla investment or the lack of? Do you buy more? Do you buy in? Do you sell out? Do you hold? First of all, I'm going to explain something very, very simple. This is definitely not the right time to go into margin. You're going to get burned. I mean, the next 2 years are going to be so insane. I'm not saying there's not going to be runs and, times of happiness in the market, but I mean, not a good time to gamble away a margin account on anything. Definitely not a stock like Tesla, which will be erratic in the next couple of years. So, assuming I'm not talking to people who have no money to invest and I'm actually talking to long-term investors. I'm not talking to traders, to short-term investors. I'm talking to people who have money, who are able to lose that money and be okay, and they have a long-term horizon. Now, if you're that sort of person, Tesla is very, very interesting. I'm not going to lie. Look at the numbers here, and I have some of the data here. It's very interesting. So this stock is phenomenal. It has $21 billion in revenue in the previous quarter. It produced 350,000 cars last quarter, and it beat expectations again. 7.5% beat above expectations on revenue. EBITDA is up 68%. Revenue is up 56%. I mean, the EV market, the global EV market is expanding, even though they have more competition, but there's more, more TAM, more total addressable market. So how low do you think it will go in the recession? Will it take a hit? Most likely. I mean, it's probably not going to keep growing like this if the market is going to go absolutely soft. But ask yourself this question. If we are talking about a 20-year strategy, who's going to be around in 20 years? And who's going to be actually dominant? Is it going to be Ford or GM or any of these companies? Or is it going to be Tesla? It's very hard to build an argument why Tesla is not one of the best companies in the world right now. Now, you might make an argument that Tesla's stock is too expensive. You might make an argument that the recession is going to wreak havoc on its supply chain and its demand. You might make an argument that the stock might drop lower and you will be able to pick it up cheaper. All of this may be or maybe not true. Actually, a lot of it makes sense to me. But here's the problem. Nobody really knows. And if you're selling right now, if you're an existing shareholder, you're selling into fear. And essentially what you're doing is you're putting yourself in a position of not ever re-entering again. Because when you sell into fear, when the stock actually starts going up, it's always going to seem too expensive to you until it's too late. That's what happened to people in 2000, 2008. They sold out because of fear, and they never jumped back in because every time they looked at it, it looked way too expensive. They waited for another dip that never came. I think trying to time this company is just not a good idea. So my advice to you is very, very simple. First of all, think for yourself. Doing research. Definitely do not, make any trades or investments based on whatever a YouTuber says, whether it's me or anybody else, whether they like Tesla, whether they hate Tesla. So that's the most important piece of it. Now, if you do not think that Tesla is a generationally great company, at least like a top 5 company in the world right now, this is not a good time to speculate on the stock. Simple. Next 2 years are going to be rough. If you think that this company is probably, I would say, in the top 5 companies right now to invest in, and you have money to lose, which is not going to bankrupt you, and you're willing to stay the course for the next 20 years, then this is a very interesting opportunity you should look into. Of course, at the end of the day, there may be other opportunities for you, maybe the index, maybe the S&P 500, but all I'm saying is that the fear I'm seeing in the market right now as far as Tesla stock seems to be more psychologically driven than anything fundamental. Even though you might make an argument about a recession slowing down Tesla, but how much do you think it's going to slow down? I mean, this company is kicking butt. Do not make a decision based on psychology or fear or greed. It's always a bad idea to FOMO into a stock, and it's a bad idea to sell into panic. Try and analyze the stock fundamentally and try to figure out if this is a good investment for your 20-year plan based on what it's doing, based on what it's planning, based on the numbers. Look at the EBITDA, look at their financials, look at their plans, try to figure out what they're doing as far as their TAM, expansion, more plants, battery technology, production technology. If you want to actually research the stock in depth, thoroughly, I highly suggest that you use the tool that me and my partner Pete built, especially for ourselves. A tool that allows you to do all that on any specific stock, especially a Tesla. This tool, if you haven't heard about it, I've been talking about it a lot, and this is my baby. We built this. It's called Stock MVP. On Stock MVP, you can do everything I ever wanted from one-stop shop platform, which I never found for myself, which is look at the financials, look at the highlights, deep dive into what the company is actually doing, look at insiders, look at politicians, look at institutionals, run your own DCF with sensitivity analysis based on different categories, different growth rates. Do all that. And because it's New Year's, we have a special code called New Year 23. It's going to be below. It's going to give you 3 months at 50% off. In any case, if you try it out and you're not happy with it, just let us know. We'll refund you money within 14 days. No problem at all. I hope you enjoyed this video. It was a little bit different. I try to keep it light and simple. No hate to Kathy Wood and her buy ARK and never pay capital gains tax again. I was just kidding around, Kathy. I'm sure you'll pay a lot of capital gains in the future, no doubt. In any case, have a great New Year's. See you in the next video.